May 19th. So today I got a special session for you guys for watching it live or on demand. I'm going to teach you a step-by-step blueprint to wealth. When I say wealth, number one, we need to define what wealth is, right? Wealth is freedom. When you achieve wealth and you no longer have to work for your money, but you actually are in a position to have your money work for you, that is true wealth. And wealth is when that money, called passive income, is greater than your monthly expenses. This is when you achieve financial freedom, because now you could travel anywhere around the world, do what you like, pursue your true passions, and you don't have to worry about a job paying the bills because your money is generating income just like any business, right? I'm here to teach you how to trade like a business so that you can actually go pursue your true passions. Make sense? So, here is your blueprint to wealth. I'm going to keep it simple, right? So that anybody can do it, because I truly believe anybody can do this. So, number one, you need to figure out what are your monthly expenses, right? Your rent, your food, your bills, depending on where you live, your monthly expenses could total anywhere between $6,000 and $10,000. So I'm going to use a simple example: $6,000 to cover all your bills. Okay, well, if that is my goal, to escape the rat race, right? To get outside of the 9 to 5, then now I know what I need to achieve, because you need to begin with the end in mind, right? Stephen Covey, 7 Habits, begin with the end in mind. So, next, if you know that $6,000 is your end goal, let me give you a pathway. Let me just show you if it's realistic or not, because we need a SMART goal. It needs to be specific, it needs to be measurable, it needs to be achievable, it needs to be realistic, and you have to put a time frame on it. So if I wanted to earn $6,000 a month of income, let's say I have $30,000 somehow in my account, right? Let's say you saved up in an IRA or a 401k, and let's say you can generate a 20% return per month on this capital. Most people will say, Nick, what are you smoking, bro? I can't even get 20% a year. But let's just hypothetically think, suspend reality just for a minute with me. If I said I could teach you a powerful monthly compounding trading strategy that you could do day after day, generating 1% a day. Well, 1% a day times 20 trading days in a month equals 20%. Now, does that sound a little bit more realistic? Because 1% a day times $30,000 is what? You divide by 100, take away the 2 zeros, that is $300. Can you generate $300, right, a day selling insurance on the market, selling bets, and you're just trying to squeeze out $300? That's not even 300. I made a mistake, because 1%, right, of 3,000, depending on what your actual goals are, you can actually work it backwards, because a 20% return off of $30,000 is 6,000. So with that in mind, we are going to, you know what? Let me rewind, because I think I may have lost some people. If I may have lost myself, actually. If you have $30,000 saved up into your account and you can learn a compound trading strategy that returns 20% a month, right? Well, we know 10% of 30,000 is 3,000. So we know 20% of 30,000 is 6,000. You double the 3,000, right? So this is our goal. This is our destination, right? Because once we have our money generating $6,000 worth of income, that is when we're on our path to financial freedom. So next, this is the second powerful formula in math. It's the power of compound interest. And compound interest basically tells you that your money will grow not linearly, but your money grows exponentially. And the reason why it grows exponentially is because your money is being compounded to the exponent, right? So let's say you have $3,000 in your account. You earn 10% interest. So you multiply by 1.10, right? Because if you multiply this times 1.10, it's going to spit out $3,300, right? Because you have your initial principal. Oops, forgot. My teacher glasses need to come on. I'm in my teacher mode right now. So 3,000 times 10% interest, you're going to have 3,300 in your bank. But because it's being compounded, now you take 3,300 and you multiply that amount by 10%, right? And then instead of $300 of interest, now you're going to earn something like 3,600 and like $15, right? So instead of $300 worth of interest, you're going to earn $315 worth of interest because you're going to add 315 to this 300. So because your money is compounding, it's like a snowball effect, right? In the beginning, it's growing a little bit every month, more and more. And then as your snowball gets bigger, your interest is compounding on itself, which then accelerates your returns. So instead of just going whatever this principal amount, notice how you're always multiplying by 1.10. Well, guess what? Here's a quick math lesson for you. You just take 1 plus the rate of return, which is 10%. And then instead of always multiplying it by 1.10 and then taking that amount and then multiplying it by 1.10, right, to get 10% of that, and then multiplying that amount by 1.10, the compound interest formula just says, well, just put it in the exponent, right? So if you do it 3 times, instead of going 1.10 3 different times, right, you're just putting a 3 in there. This is why math is so important and why I believe math in combination with money, in combination with trading the markets, is truly your power to accelerate your wealth, grow your money exponentially. And you can achieve wealth because now you can compound your money every month. Most people only know how to compound their money every year, right? I'm not talking about years, folks. I'm talking about compounding your money on a monthly basis, just like the wealthy do. Do you guys know what the wealthiest companies are? The ones that generate income month after month. So, what's really cool about compound interest, which Albert Einstein said was the 8th wonder of the world, that's how important this formula is. You can use compound interest to estimate how long it takes your money to double. All right. So there's a shortcut. You could take, it's called the rule of 72. You take the rate of return. Let's hypothetically say I can generate 24% return a year, right? Well, 72 divided by 24 tells you that your money will double every 3 years. Make sense? So what I'm proposing is hypothetically, let's say I can give you 24% per month. Now you're waiting only 3 months to double your money. And do you know how powerful that is? Let's just hypothetically say if I could compound my money every 3 months, look at how much your money can grow. We are looking at annual, it would take you 3 years, right? But if you do it monthly, which is what insurance companies do, right? When they sell you insurance, they're collecting your premium and they're compounding it month after month after month. Why do you think the tallest buildings, the skyscrapers in the biggest cities, the New York skyline, San Francisco has the Transcontinental building, Chicago, they all are insurance companies? Because Berkshire Hathaway, right? Warren Buffett, his biggest holding is in Geico, an insurance company. Because once you learn how to sell insurance on the stock market, where you could actually sell bets on the stock market every day, now we can really accelerate our wealth because now we're doubling every 3 months. And this allows you to do it by just making 30 bucks a day. You guys ready to get your mind blown? Watch. All right, guys, hold on to your seatbelts because this is what I teach my students in my class. I teach them how do you compound your money and how could you retire and reach financial freedom in less than 1 year. Do you guys even think that's possible? You guys ready? You guys ready for this lesson? Put in the chat. Raise your hand if you're ready to learn how to escape the rat race in less than 1 year. Let's go. All right. So I created this video where I'm going to show you exactly how to do it. And let's see if you guys can follow along. And I will explain when and how to do this.
Wealth functions as a math equation where specific inputs generate predictable outputs. This illustrates the first equation, financial freedom. You achieve this state the moment your passive income exceeds your expenses. First, calculate your exact monthly living costs, including rent, food, and bills. In this model, we set that target at $6,000 a month. Defining this exact monetary target is the prerequisite for any strategy. You cannot reach a destination that you have not mathematically defined. To generate $6,000 a month, we look for a strategy producing a 20% monthly return. Setting this high-performance benchmark identifies the missing variable, our required starting capital. Calculation shows a 20% return on $30,000 produces our goal. This reframes the objective. The focus shifts from the abstract idea of wealth to the concrete task of acquiring and managing a $30,000 account. We use the second equation, compound interest, to determine the timeline for our goal. Einstein famously referred to this as the eighth wonder of the world. This formula is the rule of 72. It is a shortcut to find your doubling time. You divide 72 by the rate of return on your investment. Take a moment to calculate this. If you are earning a 24% monthly return, how long does it take for your capital to double? At 24%, your money doubles every 3 months. A 24% monthly return averages out to about 1.2% a day. For someone starting with $3,000, the daily profit goal is $30. Breaking a large objective down into a $30 daily target makes the path to wealth manageable. This chart tracks the growth of a $3,000 account over a 12-month cycle. Following the rule of 72, the account doubles to $6,000 by the end of month 3. The momentum continues as the balance hits 12.
So notice how your money is doubling every 3 months. Now you have 24, and then it doubles to $48,000, right? You started with a $3,000 account, and now check this out. This is what's amazing about knowing how to manage your money. Because if you earn 20% off of $48,000, well, we know 10% is going to be 4,800. 10%, you just take away the last zero. You're dividing by 10, right? But because you're earning 20%, right? You multiply it by 0.20, you're earning $9,600 of passive income if you can earn 20% a month. That might seem like a lot, right? Because 20% of $48,000 is big. But if you think about it, it's not that big because 9,600, let me show it to you in math that's a little bit easier to understand. Let's say you have $10,000, okay? You have $10,000. What's 20% of $10,000, folks? It is, well, 10% is 1,000, it's $2,000, right? So you're like, okay, can I really earn a 20% return a month? That's $2,000 per month. That sounds like a lot, right? Where am I going to put $10,000 and actually return $2,000 of profit? I don't know anywhere. Well, let's break it down some more. What is that per week? There's 4 weeks, right, in a month. So divide that by 4 and you get $500 per week. Is that a little bit more manageable? Yeah, but still, how do I generate $500 per week? Well, let's divide that by days. How much is that a day? A day, you divide that by 5, that's $100 a day. Now, let me ask you this question. What if there was a strategy where you could take a $10,000 account and you sell insurance on the stock market, the SPX, and you can sell it every day because they have what's called 0 days to expiration, where you could sell insurance. And as long as the stock or the SPX does not get above or below a certain price, or even intraday, where you could get in and out of a trade, now you could actually use $10,000 worth of capital to generate $100 of income. Do you see why it's so powerful to learn how to day trade options on the SPX? It allows you to become a one person insurance company. You don't need $1 million to be your own insurance company. You could actually start off with as little as $2,000 because $2,000 is the new limit that you need to day trade options. Before, you needed $25,000. And then recently, they lowered the minimal pattern day trading rule from 25K to only 2K. Why? Because the explosion of SPX day trading options has exploded in volume over the last 4 years. There's more people day trading the SPX than there are people buying monthly options. There's more people day trading this than they are all other options like Nvidia, Apple, all of those combined. So you're trading in the most liquid market where all the big players are playing, because in order to build wealth, you need to think like the wealthy do. You need to think like the insurance companies and the casinos, because wealth is just a math equation. Do you know how to put the math on your side? Do you know what your edge is? Because your edge is rooted in math. Anybody that tells you they know how to pick stocks, they're BSing you. You can only manage the math and trust the math. The rest is just a process. So here is the next
Multiply the
formula,
probability of
and
a
it's
win
called
by the
the
average
positive
profit and
expectancy
subtract
formula. And this formula tells you how to put the probabilities and your profits all into an equation, as well as your losing probability and your losses, because a true edge needs to have what's called a positive expected value. That's what casinos do. That's what insurance companies do. They know how to create a positive expected value. So here's an example.
the probability of a loss multiplied by the average loss. The result is your expected value. If that value is $20, you have a mathematical edge. This means that across hundreds of trades, you can expect to average a $20 gain per trade, regardless of the outcome of any single position. Success in this model relies
So
on executing a system with a
So here, give me an example, right? So let's say you have 10 trades. This is what expected value is. It's very simple. Let's say out of 10 trades, you're only right 30% of the time, which means 70% of the time you lose. You guys follow so far? This is expected value. This is the probability times your average profit. So when you're right, let's say you make $300, but when you're wrong, you lose only $100. You define your loss. So your expected value, right, is 30% of 10 is 3. So you have 3 winners times $300, you made 900 bucks. But you lost 7 times, but you only lost $100 every time. So you lost 700 bucks. Your net profit, folks, this is the key to trading, is a positive $200. So after every 10 trades, if I want to see what is my average per trade, well, I take $200 of profits, divide that by 10 trades, my average expected value is $20 per trade on average. Taking into account my winners and my losers, I'm expected to make about $20 per trade. So now all you have to do is say, okay, well, if it's $20 per trade, now if I just place 10 trades, I can expect to make $200. Or if I want to trade 2 contracts, I'm expected to make $40. Now, wealth truly is a math equation. And this is what I'm going to teach you step by step in my trading system, because my trading system is
Net
all
positive
math.
expectation, and trusting the long-term math over individual losses. To apply these three equations, many successful traders use options on the S&P 500. This strategy involves acting like an insurance company or a casino, where you provide the market with probability-based coverage. On this SPX chart, you identify accident price levels far away from the current market action and sell insurance to other traders at those levels. As long as the market remains above your chosen level, you collect and keep the premium. By combining specific daily targets, compounding interest, and a positive expectancy insurance strategy, wealth building moves from a game of chance to a system of disciplined mathematical execution.
And that is your path to wealth, folks. How many of you guys feel that that was powerful? I normally teach this to my students and they understand it. So here is the S&P 500. Do you guys want to see the math in action? Because when you're trading, this is the daily chart right here. All you're doing is you're taking probabilities. I placed a trade and I sold insurance way up here at 7,400. See this? When price was near here, I said, you know what? They're not going to break above 7,400 because there's a big resistance here and there's a lot of volume. So what I did was, you can see in this trade, I went in and I sold. Remember, you want to be a seller. You don't want to be a buyer. So at 11:45 Pacific Standard Time here in California, I went in and I sold to open, right? The 7,400 call. Remember 7,400? And I received a credit of $80. Remember, you have to multiply this by 100. So look at my profit so far for the open. I'm up $115, right? I'm just trying to generate 50 bucks. This is, if you want to see how much it's worth right now, I can go in and right click and say create opposite order so I can exit it. I sold it for 80, right? Guess how much I can sell it for? I sold it for 80. Now it's worth 0. So basically I made 80 bucks there, right? Because if you sell something for an $80 credit, right? I got a credit. That's what credit means. And now if I want to close out the position, create the opposite order, I have to buy it back. How much do I have to buy it back for? 0. You know why? Because the probability of this S&P 500, what's the probability that's going to get above 7,400 when it's way down here and there's only 10 more minutes? The probability is 0. That's why these option prices at 7,400, it's worth only 0, right? But this is because this is expiring today in 10 minutes. But look, the one that expires tomorrow has 1 day left. Well, look at the 7,400. It's selling for $7.20. So if I thought that it's going to stay below 7,400, I can sell this and then I'm going to go buy this one. I get a credit of $1.10. I'm going to send that one through. And so now this, I'm able to collect premium. I'm selling premium. I'm selling insurance. There, I got filled, right? So here, what this says is that I just got filled and I placed a bet as the insurance company or the sports book. I just sold this for $110, right? Because if you look, you'll see that an option is 100 shares. So that's all you're doing is taking advantage of probabilities, open interest, and knowing how to trade with a purpose. Because most people, they fail because they don't know why they're trading. What's their goal? It's not smart, right? It's not specific. I told you how specific you need to be. $30 a day, right? 1% of your account. Do that for 20 days. That's 20%. Use the rule of 72. You can double your money every 3 months. Now you're trading with a purpose. You're trading with clarity. You're trading like you mean it. That's what Trade Like Nick is all about. How to put the math on your side, how to be mechanical, and how to remove your emotions. Master your mindset, and the rest is just the equation. You now have the wealth blueprint. And that's why I invite you guys to join me on this journey, the wealth accelerator method. That's what I figured out over this entire 20 plus year journey of mine, where I learned math, became a math teacher, became an options trader, and then finally combining the math with the trading and creating an actual trading system that allows you, anybody with a small amount of capital, to truly accelerate your wealth. Money doesn't have to be just for the wealthy. I truly want to bridge that gap between the people that have money and the people that don't. Because in this future economy, with AI being prevalent everywhere, taking away jobs, you need to learn a skill that can pay you so that you don't have to rely on a job, somebody else to pay your bills. You have your money now working for you so that you no longer have to work for it. And that is the true definition of financial freedom, of breaking out of the rat race. And that's what I'm offering to you guys. So if you guys like what you hear, you guys want to learn more tips, more specific strategies, like and subscribe. And I'm going to be delivering content every day so that you guys can join me and build wealth together. All right, everybody. Peace.